What's up guys, Jake here. In today's video, I'm going to walk you through an example, start to finish, how to sell a covered call on Fidelity's platform. Of course, I am assuming that you know what selling a covered call is. If not, I will include my playlist down below of my selling options videos. This video goes much more in detail about tips and strategies related to selling covered calls. But in this video, let's talk about how to do one on Fidelity's platform. First thing you got to know is you're going to have to probably enable margin, so you'll have to apply for that. And then you can just search up here for options, apply to be approved for trading options on Fidelity's platform. They have 5 levels of options trading, and I think level 3 gets you covered calls and cash secured puts, which are probably the most common forms of option trading. So once Fidelity has approved you for both margin and options trading, you are now free to sell covered calls. The next thing you got to know is you actually have to own 100 shares of a stock. So this is my Fidelity account, and mostly I just buy call options. I do options trading in my Fidelity account. I don't buy individual stocks. However, for this video, I did buy 100 shares of Bank of America. That is the stock that we're going to be selling a covered call on. And there's a couple different ways to do this. The first way is if you own the 100 shares, you've already purchased them, you can just click on it. And it'll tell you buy, sell, or option chain. We are going to click on option chain. And this is what the option chains look like on Fidelity's platform. There's going to be a lot of information here for you. So first thing we want to do is select an expiration date. And it's going to default show you the closest 8 or so. So I'm going to deselect everything except April 16th. The reason why is because April 16th is the third Friday of the month, and the third Friday of the month always has the most liquidity, the most people buying and selling option trades, so the bid-ask price difference will be the smallest. So April 16th is about 2 weeks from now, so we're going to go ahead and do April 16th. And since we're selling a covered call, we don't need to look at the puts, so I'll go ahead and switch this to just calls, and I'll hit apply. So here is the option chain for April 16th. This is 17 days in the future, and it shows me about 10 strike prices. And the closer you get to an expiration date, the more it's going to give you these closer strike prices. So we have 37, 37.50, 38, 38.50. Bank of America's share price right now is at $39.14. So anything below 39 is in the money. Your shares will be called away. Anything above 39 is out of the money. So what we want to do is sell a covered call, potentially on a strike price that's out of the money. We don't want to guarantee that it's going to get called away. And when you do this, there's two Greeks that are useful to reference. The first one being implied volatility. This measures how much movement in the option contract prices has there been recently. If it's low, you're not going to get as good of a premium when selling a covered call. And when this number is higher, then you'll receive more money, which increases your break-even price, which decreases the chance of you losing money should the share price go up and your shares are called away. An IV in the 30s is just meh, kind of average. I like to see that at least above 40. If it's in the 20s, you're not getting a good premium price. The second Greek is delta, and delta has 2 purposes. One shows you how much the option contract will move per $1 movement in the share price of Bank of America. But another useful use for delta is it gives you a rough probability of this contract expiring in the money. So this 0.46 for the strike price of 39.5, it's giving you roughly a 46% chance that this contract will expire in the money. When we look at the strike price of 37, it's giving it a 78% chance of expiring in the money. And once again, this is in 17 days. Would the price go below $37? So when selling covered calls, I talked about this in my strategy video, but generally you want to aim for that 30% range. So yes, sometimes your shares will be called away, and you're paid for it. You're paid the strike price, which isn't a big deal. You still collected the premium. But a lot of people would prefer not to have their shares called away, and they're just collecting a good amount of premium every 2 weeks to a month by frequently selling covered calls. So in this video, let's actually select the strike price of 40. And the reason why is because you'll notice these 0.5 values, these histograms here are showing the amount of contracts being buy and sold. So there's not a lot of liquidity for the 50-cent intermediate strike prices. So we'll go ahead and select the 40, and we'll click this drop-down menu, and we're selling to open for covered calls. So this is Fidelity's trade window. There's a couple different ways you can do it, but this one is the pop-up that will automatically appear. Transaction type is options, symbol BAC for Bank of America. We're selling to open, and because we only have 100 shares, we're only going to be selling one contract, so quantity of 1. Expiration date, April 16th, strike price of 40. This is a call. And for order type, you can do a market order, but that will just fill it at whatever the closest bidder is bidding. So you don't want to do that. You want to always select limit, and then use this this graph over here. For smaller cap stocks, this bid-ask spread will be much wider, but because there's so many volumes of trades occurring right now, the spread is only 1 penny. So the buyers are bidding 0.74 and the sellers are asking 0.75. I don't know why Fidelity defaulted me at 0.72. That's not a good amount. So we're going to increase that to 0.74. This jumps up. Now, if you want to be an aggressive seller, you know, the buyers are bidding 74, the sellers are asking 75, just put 75 and then wait a couple hours potentially for it to fill if you've got the time. Because I'm filming this video, I'm going to go right to where the bidders are asking for 74 because I want it to get filled right away. So we'll go ahead and scroll down and click on preview order. And actually, while we were filming this video, it actually jumped up again. So now the sellers are asking 77. They're getting more money for selling covered calls, and the buyers are now bidding 75. So we're actually going to click on edit order. We're going to change this to 75 so that we can get an extra $1 for this premium. That's pretty sweet. We're back at preview order, and we're going to click place order. All right, I'm back on my positions page, and you'll notice that I've organized by symbol, otherwise Fidelity doesn't group them together. And I've got 100 shares of stock on Bank of America, and I've sold a covered call. And you know you sold a covered call because it'll say here in the descriptor call, and it's a -1, meaning that you generated the contract and you sold it to somebody else. So if we click on this, it'll give us our purchase history, you know, the date acquired, what's our gain loss, because when you pay 65 cents to the Chicago Board of Options Exchanges, you're always going to see this negative value immediately off the bat, but it's not a big deal. And what you're hoping for is that the Bank of America share price does not go above $40 per share. So currently it's $39.21. If it gets above 40 in 2 weeks, then my 100 shares will be called away. But your break-even price is what you were paid for the option contract. So what did I pay here? So in the far right column, my cost basis was $74.30, or the premium was 0.74. So my true break-even price is the premium plus the strike price, so $40.74. I'm not net losing value unless Bank of America's share price gets above $40.74. It's possible it could. But for people who sell covered calls, they don't care. You make money no matter what. You're selling your stock for above what you paid for the stock for the strike price, so that's a win. Plus you get the premium. So you're always making money when you sell covered calls. Now, yes, the stock might have appreciated and you're losing that value. Whoever bought the call contract is now holding the stock and they can sell it if they want. But selling covered calls is a very conservative form of options trading that, you know, if done successfully, can generate you a lot more money when holding a lot of shares of stock. How much can you make selling covered calls on, for example, Bank of America? Let's pretend like you sold a covered call once a month and you made $74 on that premium. You do that 12 times, that's like $888. Divide it by how much money you spent to hold Bank of America stock, about $4,000. You're getting close to a 20% return on your equity for the year if you just sell covered calls once a month and you're earning $74 on locking up $4,000 worth of Bank of America stock. Covered calls, if you're dedicated and patient and you're willing to check your account every couple weeks to make sure that it's tracking and you didn't lose your shares, it's a pretty good form of options trading, very good investment. Last thing I need to tell you is that people want to know how to get out of their covered call. Let's say that the value of the contract, let's say Bank of America stock goes down, and how much you've net made on your covered call is close to 80% worth of the premium. So you've locked up most of the extrinsic value in the contract, and you want to close it and then sell another covered call for another 30 days or whatever. So what you can do to exit this position is click on buy to close. So you sold to open to get in and you got this -1. You now have to buy to close the exact same contract to exit it. -1 + 1 = 0. It'll cancel out. Here's the trading window. We can go to we can do a market order if we want, but I think we can get away with doing a limit here. And once again, the buyers are bidding, the sellers are asking. I'm just going to do 0.76 because I want to exit this position for this video. But once again, if you're patient, put in a lower amount to make more money. So we're buying to close what we sold to open, and it's the exact same contract. Let's go to preview order. Looks good, and we'll place order. And when we refresh the page, the covered call is now gone. I still have the 100 shares of stock. If you want to sell that, you also have to do an additional sale for that. But the covered call, because I bought to close, it canceled out my sale to open. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. If you have any questions or comments about trading options, definitely check out my playlist. I will include the link down below, or leave me a comment. I will help you if I can. Until the next video, take care.